Now, in what is probably the first judgment that follows the principle of the controversial GAR or General Anti-Avoidance Rules, which have spooked the markets, the Authority for Advanced Rulings has denied capital gains tax exemption to Mauritius entity on a buyback deal. Ashwin Mohan joins us with more details on that. Ashwin, this is bad news yet again for entities who rely on the Indo-Mauritius tax treaty.
That's right, Nisha. In fact, of late, there hasn't been any positive news coming in for investors who rely on the Indo-Mauritius double tax treaty for tax benefits. The controversial GAR recommendations was a shocker, which in fact had a deep impact on the markets. And this is probably, as you correctly pointed out, the first judgment that has been passed in the spirit of GAR. GAR, of course, is a general anti-avoidance rules. Now, what has happened in this particular case is that the AAR, or the Authority for Advanced Rulings, has denied capital gains tax exemption on a buyback which took place between an Indian company. In this case, the name of the Indian company was Otis Elevators. It's a well-known company in the elevators business. And the Mauritius company was Otis Mauritius. So what has happened is that the capital gains tax exemption has been denied, and this entire judgment was passed on a buyback deal which was executed between Otis India, that is Otis Elevators India, and Otis Mauritius between 2001 and 2005. Now, what is really interesting is that the AAR has also come out with certain strong statements on the nature of the deal. They are calling this entire buyback deal as a colorable device which was designed and created solely to avoid tax. And that, of course, forms the heart of GAR, and that's why this judgment assumes great importance. In fact, the AAR, I understand, has also pointed out that this entire buyback deal was not a buyback deal at all. It was just in the nature of dividend income, and hence tax needs to be paid on the deal. Now, the message that will come across to foreign investors from this judgment, of course, is that slowly and steadily the Indian courts are applying the principles of GAR. Keep in mind that GAR is, the finance bill is yet to become an act, but the Indian courts are slowly and steadily applying the principles of GAR. And after this judgment, every entity which is routing their investments to Mauritius will have to very carefully structure the transactions, because the Indian courts are going to go at the heart of the transactions. And if there is any remote evidence of there being an intent to avoid tax, then they will clamp down on that. So therefore, this is quite a precedent-setting judgment, and this will set the ball rolling as far as several other transactions are concerned. Because remember, this transaction took place between 2001 and 2005. There might be several other transactions too, which might now come under the scanner of the Income Tax Department, and the taxman will definitely benefit from this favorable ruling.
Right, Ashwin. So definitely a big judgment and a precedent that has been set.